Thanks for clicking. Canada's fixed mortgage rates are surging upwards in the wake of the Federal Reserve's announcement that it would be holding on interest rates, though the Fed did announce that more hikes could be on the way.
Doesn't really seem fair.
No, it doesn't. But it does point to another element in the Canadian mortgage rate story, in that, to a certain extent, there's only so much the Bank of Canada can do. Yet the news and the rising rates come as mortgage interest costs are accelerating, up 30.9% in August. And, as we've talked about before, some, including TD's Craig Alexander, have noted that since rising mortgage costs represent such a high portion of Canada's CPI that the Bank of Canada can indeed pause. Wednesday's announcement from the Fed Chair and the subsequent increase in mortgage rates shows that the Bank of Canada isn't exactly in control of this metric. So what I want to do today is go over my best mortgage rates for the month of August, take a look at which rates the Bank of Canada does control, and even more important, the rates which it doesn't and what that means going forward, and then discuss what to look for next. Speaking of next, the end of the month is fast approaching, and with that we're expecting the local real estate data to start trickling out from the local boards later next week, and we'll obviously have an update out on that data on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into these mortgage rates. Onto the mortgage rates. First up, my best 5-year fixed insured mortgage rate. An insured mortgage rate, if you'll remember, that's where you have less than 20% down. You qualify based off the greater of the contract rate plus 2% or 5.25. You have a 25-year amortization and you pay the mortgage insurance. My best 5-year fixed insured rate in July was 5.34, which popped up a little in August to 5.44 and is now sitting at 5.64. With my best 5-year variable sitting at prime minus 1.05 or 6.15%. So 5-year fixed insured mortgage rates up about 30 basis points over the past 2 months, all without the Bank of Canada doing anything to interest rates. Next up, my best 5-year fixed insurable rate. Insurable mortgage rates, if you'll remember, that's where you have that 20% down. You qualify on the greater of the contract rate plus 2% or 5.25. You have a 25-year amortization and you don't pay the mortgage insurance. My best 5-year fixed insurable mortgage rate in July was 5.89. That jumped up in August to 6.09 and is now sitting at 6.19, with a 5-year variable rate mortgage sitting at prime minus 0.05 or 6.7%. So, insurable mortgage rates where you qualify like it's insured but you don't pay the mortgage insurance and you have 20% down, up about 40 basis points since this point in time in July. And finally, my best 5-year fixed uninsurable rate. Uninsurable mortgage rates is where you have 20% down. You either take money out of your home vis-a-vis an equity takeout or have a 30-year amortization. You qualify at the greater of the contract rate plus 2% or 5.25, and of course you don't pay the mortgage insurance. My best 5-year fixed uninsurable rate in July was sitting at 5.89. That jumped up to 6.19 in August and is now sitting at 6.29, with my best 5-year variable rate mortgage sitting at prime minus 0.4. or 6.8%. So 5-year fixed rates up all across the board, all up between 30 and 40 basis points since this point in time in July, all without the Bank of Canada doing a thing.
I swear to God I had nothing to do with that.
So what happened? As mentioned, the Federal Reserve announced on Wednesday that it was holding on interest rates, though did hint that more hikes could be on the way. Treasury yields subsequently shot up to a 16-year high, as investors are now starting to realize that rates could stay higher for longer. The yields on 5-year Canadian government bonds also jumped up higher, with yields jumping almost as high on the Fed announcement as they did when our own inflation rate came in hotter than expected.
The one who calls the shots.
And yeah, to a certain extent, that's the case. As we talked about before on this channel, the Bank of Canada controls the overnight rate, the rate the banks pay to each other when they loan money overnight, and the bank rate, the rate that the banks pay to the central bank, to the Bank of Canada when they're not able to get funds from each other and have to go to the central bank to borrow money.
In other words, when you need me to take care of something for you, then you need me.
Yeah. But the bank does not control fixed rates. Those are controlled by the market for government bonds. When the government wants to borrow money, it issues bonds. And those bonds are bought by banks, central banks, insurance companies, and from you and I. And with the Federal Reserve thinking that interest rates are going to remain higher for longer, that means inflation is likely to remain higher for longer. And as such, U.S. Treasury yields are surging upwards. The U.S. government is going to have to pay more to borrow money. As such, since the US is considered the safest borrower in the world for now, the Canadian government is going to pay more to borrow money, and as such, you and I are going to pay more to borrow money as well. And this essentially means that since the Bank of Canada does not control the bond market, that they could lower rates down to 0% tomorrow.
Okay.
They could lower rates to 0% tomorrow, and it wouldn't make the interest cost on fixed rates any less expensive. In fact, were the bank to act in a manner that was perceived to be reckless, perceived to not be tackling inflation, that would probably trigger a visit from the bond vigilantes. Very briefly, a bond vigilante is a trader who threatens to sell or actually sells a large amount of bonds to protest or signal distaste with policies of the issuer, with policies of the government. So what this means is that if bond vigilantes, if holders of large amounts of government bonds don't like the policies of the government, they can sell those bonds en masse, which would decrease the price of those bonds, setting yields upwards, which would also send mortgage rates skyrocketing upwards as well.
Somebody should stop him.
And we've seen this time and time again, most recently and most notably in the UK in 2022, when traders thought the government wasn't serious about tackling inflation, dumped UK bonds, or gilts, and yields skyrocketed. And to understand why bond traders do this, let's take a brief look at how yields actually work. Say I lend the government $100 at a 5% interest rate. At the end of the year, I'm going to receive $105 back. I am yielding 5%. However, I see that the Bank of Canada has now lowered interest rates back down to say 2%, and I know from history, from experience, that the real estate market is going to surge back upwards, that people are going to borrow and spend, and inflation is likely to go back up to say 7%.
Maybe, maybe not.
So if I hold my bond until maturity, I will get that $105, but with inflation at 7%, that $105 is only going to be worth $97.65 worth of purchasing power. So I actually lost money loaning it to the government.
It happens.
Not wanting to wait for the government to reduce my purchasing power, I sell my bond now, and so does everyone else. And now that bond is only worth, say, $90. Now, that $90 bond that's going to be paid out $105 at the end of the year is now yielding 15%. And now, after all of that, after everyone has dumped their bonds and existing bonds are now yielding 15%, if the government wants to issue any more debt, if the government wants to borrow any more money, it's going to have to pay at least 15%, if not more. Why would anyone loan the government any money at less than 15% when they can pick up a 15% return on the bonds that are already out there? As such, since the government has to pay more to borrow money, so do you and I.
But that didn't really work out.
And we've been seeing this throughout the year, with article after article noting that in the aftermath of the pandemic low rates, the bond vigilantes are back.
The one who calls the shots.
Bond traders, bond vigilantes have been threatening to dump their bonds, sell their bonds, if governments pursue policies which could threaten the value of their currencies, and hence threaten the real return on these bonds. So, contrary to the popular opinion amongst you-know-who, amongst the real estate industry in general, were the Bank of Canada to actually lower rates back down, were the bank to be perceived to not be tackling inflation, that would in fact do more harm than good. If the Bank of Canada, if governments, if central banks in general don't act responsibly on their own, the bond vigilantes will force it. So, fixed mortgage rates up all across the board, despite the Bank of Canada having paused on rates, having no new interest rate hikes for the past 2 months. What this shows is that the Bank of Canada does not control fixed rates. They control floating rates, they control variable rates, they control the overnight rate. However, were the bank to act in a manner which was perceived to be irresponsible, fixed rates would skyrocket upwards. And, as history has shown, the bank would probably have to back down. All in all, I think the key takeaway from all of this, from what we've seen following the Fed announcement, from what we've seen with mortgage rates and the bond market, is that monetary policy is a little bit more complicated than just the Bank of Canada. There's a lot of factors at work, and the Bank of Canada, in a global sense, has very, very little control over what happens with interest rates. With that said, we will continue to monitor what the Bank of Canada can and does control on this channel. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.